Okay, so this is for the subject capital markets, and this particular video will be about secondary market. Again, we have here an article from investopedia.com. Okay, so for the definition, secondary market, it's where investors buy and sell securities they already own. So essentially, it's a transaction between one investor to another investor. Again, reason, what do you call this? If an investor doesn't want to hold onto a security anymore, then he would also want to sell it off. And then in case he needs money and, his funds are tied into a security, then he would have to sell them so that he can get the money he needs. Okay, so in a way, the secondary market provides an avenue for the securities to be liquid or easily convertible to cash because there are existing sellers or buyers of the security. Okay, it is what most people typically think of as the stock market. Those stocks are also sold on the primary market when they are first issued. Again, so to reiterate, primary market issued for the first time, and it's normally a transaction between the issuer, the company or the government, to the investor. Okay, but normally through an underwriter, right, or an investment bank. But essentially, it's between the company and the investor, and then the funds from the investor goes directly to the company. Okay, it does affect the company because the funds given by the investor would be used by the company for whatever purpose they are conducting the fundraising, either for payment of debt or for expansion of their operations. But in the secondary market, when it's between an investor and another investor, so the exchange is between the two of them, one sells the securities and then the other pays him with money. So the transaction does not actually affect the issuer of the company. So let's say selling shares of JFC, Jollibee. So the money would be exchanged between the two of them. The shares of stock would be transferred from one to another, but it does not affect the company. Right? They don't have a transaction with the company, right? The national exchanges such as NYSE and NASDAQ are secondary markets. Here in the Philippines, we have PSE, Philippine Stock Exchange. Understanding the secondary market, those stocks are one of the most commonly traded securities. There are also other types of secondary markets. For example, investment banks and corporate and individual investors buy and sell mutual funds and bonds on secondary markets. Entities such as Fannie Mae and Freddie Mac also purchase mortgages on a secondary market. Here in the Philippines, banks as well as investment houses, investment banks, other financial institutions, they do engage as well in trading, right, or in acquiring securities from the secondary market. Transactions that occur in the secondary market are termed secondary simply because they are one step removed from the transaction that originally created the securities in question. So for example, a financial institution writes a mortgage for a consumer, creating the mortgage security. The bank can then sell it to Fannie Mae on the secondary market in a secondary transaction. Okay, so in that case, that's already the secondary market. Key takeaways: in secondary markets, investors exchange with each other rather than the issuing entity. Okay, through a massive series of independent yet interconnected trades, the secondary market drives the price of securities toward their actual value. Okay. Comparison, primary and secondary. It's important to understand the distinction between the secondary market and the primary market. We've reiterated this many times in the previous video about primary markets, but let's have it for one last time. So, primary market, issued for the first time directly from the issuer to the investor. Secondary market, one investor to another investor. Okay, so that's essentially it. Okay. Secondary market pricing. Primary market prices are often set beforehand, while prices in the secondary market are determined by the basic forces of supply and demand, if there are investors willing to acquire the security or not. If the majority of investors believe a stock will increase in value and rush to buy it, the stock's price will typically rise. If a company loses favor with investors or fails to post sufficient earnings, its stock price normally declines as demand for that security dwindles or decreases, right? Multiple markets. The number of secondary markets that exist is always increasing as new financial products become available. In the case of assets such as mortgages, several secondary markets may exist. Bundles of mortgages are often repackaged into securities such as GNMA pools and resold to investors, although not very popular here in the Philippines normally, right? Here in the Philippines, we normally have the stock exchange, and then bond market, not yet, not easily accessible, but it's there. Okay, other markets, same with bond market. Okay, so that's it for this one, secondary market. Again, we've also discussed some of these in the previous video, primary market, right? All right, so that's it for this one. Thanks and bye.